For an intelligent investor, investing is a simple game that is actually made harder by the financial service industry that it is. At least, that's what Warren Buffett says, that you do not need exceptional intellect or money or time to become a millionaire. So how eager are you to become a millionaire? This is the video where we take a simplified look at Benjamin Graham's The Intelligent Investor, which is often called the Bible of value investing. If you do not know who Ben Graham is, he is the founder of value investing philosophy and the guru of Warren Buffett. Mr. Buffett described it as by far the best book ever written on investing. Reading The Intelligent Investor, Buffett had no doubt that he would eventually become a millionaire. So we invert and break down the lessons from the book to give you a simple, proven system for becoming a millionaire by investing in stocks. So make sure you stick tight till the very end of this video. Chapter 1: Intelligent Investment Strategies for You. So an intelligent investor finds undervalued stocks and constructs a diversified portfolio. Here is a checklist we made to simplify the various strategies and reach millionaire status. Number 1. Individual stock checklist. Undervaluation. PE ratio less than 40% of the highest PE ratio the stock had over the past 5 years. Trades below book value. PB ratio less than 1. Growth. 5-year CAGR of revenue and profits are better than peers and numbers higher than inflation at least. Similarly, profitability margins also have to pass this test. They have to be better than peers and be rising. Debt. Debt to equity ratio is less than 1 and the current ratio is above 2. Number 2. Portfolio construction. While each stock has to pass this checklist, there is also overall diversification of the portfolio to lower risks further. Top-down approach. For this, select sectors that you are capable to understand are doing well macroeconomically. You need to select market leaders or challengers. For example, the banking sector can have HDFC Bank and ICICI. The consumer sector can have HUL and ITC, and so on. 5 to 7 sectors can provide you needed 10 to 15 stocks. Bottom-up approach. Here, each stock is based on merit, but the sector may not matter. Here, the goal is to find undervalued potential multi-baggers even from underperforming sectors. For example, some say Tata Steel is going to outperform steel sector stocks in the current cycle due to favorable profitability and low debt. Apart from this checklist, don't forget to keep a margin of safety in each investment. Similar to how you leave early to catch a flight, you should keep some buffer for errors in investments as well. Graham has given intrinsic value equals earnings per share times 8.5 plus 2 times expected annual growth rate formula, but you must not invest at a price that is not significantly far from the intrinsic value. For example, the average growth rate for HDFC Bank is around 18%. By this formula, its intrinsic value will be about 2,970 rupees, at an EPS of 66.8 rupees for 2022. The current price is 1,630, which indicates a 45% undervalued nature. So, an investor is safe buying such investment, trading way below its fair price. Doing this will beat the goals of inflation and benchmark indices. Even just a 1,000 rupees SIP investment a month when growing at 20% CAGR can turn into 1 crore in 25 to 26 years. For 5,000 per month, you can do that in 18 years. If you're liking this video so far, drop a like and press the subscribe button for more such content. Chapter 2: Investment and Inflation. First, let's begin with what goals we have in mind. An intelligent investor to become a millionaire will have to strike 2 targets. The first one is to beat inflation and the second is to beat the market. Value investing strategy by itself is sound but cannot make you money without your due diligence. So, your first target is to beat inflation. Why? Inflation is just a general rise of prices in everything, which renders your money a little less of its own value each day, month, and year. For example, 100 rupees today will be worth only 92 rupees after 1 year at 8% inflation. So to break even, the investor will have to find ways to grow their money by at least 8% each year. For his small amount to grow into a million, he has to consistently find good opportunities that grow much faster than inflation. Stocks as an asset class are a good hedge against inflation as products, and service costs rise as inflation is inherently accounted for in company profits. For example, Nestle India is a company that makes the well-known instant noodle brand Maggi. If the cost of raw materials like wheat and oil rise, then the price of the Maggi packet also goes up from 10 rupees to 12 rupees. This gets accounted for in profits, and hence, Nestle India stock will quite likely beat inflation. The second target over that is beating the market, or the indices that are the benchmarks of measuring market returns. This means Sensex or Nifty in India, which have delivered about 16% CAGR returns. So for India, the majority of history has seen between 6 to 8% inflation for common consumers, and benchmark indices have delivered and beaten inflation by 8 to 10%. An intelligent investor has to at least beat the first and, if possible, second too. Savings accounts return about 4%, while gold returns in the last 25 years are 9.4% CAGR. Both of these investments do not have an edge over inflation, and it can be good to stay away. The example of Nestle India has sported a 21% CAGR in the last 5 years and completed both targets. Now, let's look at how to invest. Chapter 3: Investment versus Speculation. The intelligent investor defines two clear strategies for participating in financial markets, which are investment and speculation. We all know markets are volatile. Stocks running 52 weeks high a week ago can tank to 52-week bottoms today. This edgy and impulsive behavior of the market has been personified by Graham as Mr. Market in his book. Mr. Market is simply the average of all investors in the market. He's very fickle-minded and is easily influenced by what his neighbors or stockbrokers say. He will go out and buy more stocks when he reads the news of some fad turning rags to riches only to see it tank a few days later. In short, Mr. Market is someone who buys high and sells low while going with the flow and acting with the crowd. For Graham, this is a quick and sure way to go bankrupt. So if you're like Mr. Market, who believes everything they hear on finance TV channels or from broker recommendations, and act for a quick buck, then you are a speculator. Speculation is a bet where one does not know or care about the underlying fundamentals of the investment. Saying the price of the stock will go up or down without fundamental analysis merely by gut feeling or looking at charts is speculation. On the other hand, investment is a careful study of business fundamentals and comparing with what price levels are against the intrinsic value. According to Graham, the intelligent investor is disciplined, patient, and eager to learn. More than possessing any special intelligence or high IQ, what he needs is high EQ or emotional quotient. The intelligent investor can think rationally and act objectively. In fact, he needs to have the emotional capacity and discipline to act against the crowd in a contrarian manner. This strategy is not based on mere luck or copying others, as some economists have stated. But before we move on, go down in the comments and type what you like to do: investment or speculation. Chapter 4: The Intelligent Investor with Proven Record. So, if we say that this investment strategy is simple yet proven, what do we mean? This story comes from an appendix to the book, which is a lecture from Warren Buffett. The strategy of value investing that was pioneered by Ben Graham in his book The Intelligent Investor is very simple. It goes based on the mantra: price is what you pay, value is what you get. You just have to buy stocks at a price lower than their intrinsic value at a margin of safety. Eventually, the market will come to recognize the value, and you will prosper. However, in the 1980s, another theory about the stock market was taking it by storm called the EMH, or Efficient Market Hypothesis. Proponents of EMH argued that the markets were efficient since all relevant information about the business fundamentals was public, and hence, investors and traders always priced at that end. That is, undervaluation, as the school of value investing thinks, does not exist as stocks are valued at the fundamental value at all times. EMH proponents began attributing the success of super investors like Warren Buffett, Walter J. Schloss, William Durrani of Sequoia Funds et al. To mere luck and copycat investing. All these intelligent investors with over 20% CAGR returns were just lucky in their pick, which is probably because they are a small portion of a large investing community, and allegedly, they were copying each other's investments so they succeeded together. Buffett took on these allegations to show that intelligent investors' philosophy was founded on Ben Graham's ideas and was not at all dependent on luck or copying. He explained that the strategy was quite simple, as the above mantra showed. If a group of investors with the same investment philosophy are proving to be better than indices or other professional investors, then we should be understanding that strategy. He also showed how the individual stock picks of these investors were quite different. The simplicity of this strategy is that Walter Schloss did not possess any college degree. He just went to night seminars of Graham to learn it. Another investor, Perlmutter, learned it in just 5 minutes of conversation and beat the market returns with just that. Their investments and particular style seldom were the same. Schloss held a very wide portfolio of over 100 stocks while Buffett dabbled in 15 to 20 at most. So, the strategy is definitely simple and proven, and has turned investors into millionaires, not depending on luck or copying others. So, we know the intelligent investor strategy is simple and proven, and can make you a millionaire like many. In summary, hunt undervalued stocks, don't be afraid of market volatility, and follow the fundamental analysis checklist to construct a portfolio as we showed above. Just be consistent and patient for a few years when you will start seeing amplified returns. So before you move on, go comment below which approach of value investing you prefer, bottom to up or top to down. So go start investing. Press the like button if you didn't, and subscribe to the channel for more such content. Do you want to know more about how money works and want to maximize your investment returns? Then visit this video to the Psychology of Money book summary.